Now, I spoke to you regarding the MTAR line, basically, and so I wanted to illustrate that a little bit closely here, because this is a very important part of all of the exemption versus non-exemption. Let's say, again, we go back to Jessie, and she's 30 years old right here, okay, and she bought a $200,000 universal life policy, whatever, it doesn't matter, you know. And so she makes her first payment right here, and remember, let's assume she bought it after December 31st, 2016. In other words, it's a brand new policy, basically. So in that case, then, she, according to the rules, okay, it follows the new policy, which is an 8-pay endowment policy to age 90. So we're just going to assume that that's the new world order. But remember that it could be a 20-year endowment, 20-pay endowment to age 85 as well. But this is the newer one, so we'll just illustrate that point, okay? So she's made, basically, she can make as many payments as she wants, but this is the route that it must follow, okay? So this is a $200,000, age 90 is as far as it goes to exemption, testing, and everything else the insurance company must do, okay? And of course, that's the MTAR line right there, okay? That very important line. So as you can see, that the MTAR line is very much based on the age of the individual, the premium, the coverage that they're paying, and whether it's male or female, smoker, non-smoker, things of that nature. There all impact this particular line. Okay, so as long as the money is sitting in here, okay, all that money is sitting all in there, then it's an insurance contract. Ottawa will look at it and say, okay, it is within the MTAR line, so it could be right up to the line itself, but it doesn't exceed it, okay, it could be up to the line itself, doesn't exceed any amounts of there, therefore, as long as the money is sitting in there, then it is tax-sheltered money. So therefore, it is an insurance contract. And therefore, no T3s, no T5s, none of that stuff at all. So the insurance, so basically Ottawa will say, yeah, you're right, it's an insurance contract, so we'll leave you alone, okay? Even though within that, you can have interest, dividends, capital gains growing, and everything else, okay? The point is that it is a tax-sheltered money. However, it will lose this exemption, okay, if the accumulation exceeds that MTAR line. So if at any point in time, let's say it goes up to here, for example, now you've gone over that line. So now Ottawa says, well, just a minute now, is now an investment contract. It's an investment contract. In other words, you didn't do this just for insurance purposes because you need $200,000. You really did it because what you want to do was the tax sheltering. And now you've exceeded that particular line. So therefore, as far as we are concerned, it's an investment product. And therefore, now you're going to have to pay tax all the way to day number one. In other words, it's always been an investment contract. So as a result, we're going to go right back to day one, and we're going to tax you on all the growth every single year that you should have paid tax, plus penalties, all those kind of things that can happen. Okay, so it's quite serious. And once you've lost the exemption, unless you do something, which we'll look at the remedies in a moment, you lose it forever. So this is not something you say, okay, well, I made a mistake, I'll fix it now, and then we're back in business again. No, if you lose it, unless you do, like I said, some of the remedies, which we'll look at in a moment, okay, if you ignore those remedies, you lose it forever. So Ottawa will always look at this as an investment contract, in which case then you start getting T3s and T5s. So let's take a look now at some of the remedies. The good news is that the insurance companies test these things at the anniversary date of your policy. So the day before the anniversary, they automatically do a testing and everything else to make sure that it stays within the line. But let's say somehow, whatever it is, it exceeded. You did very well in your investment. You picked the right investments. You put enough money into the policy. You did all the right things and everything else. And now you, in fact, are over that line. So that's where the issue is. You're over that line. You do have a 60-day grace period. In other words, a letter will come out to you, basically, from the insurance company saying, hey, this is the issue. You've got 60 days to make up your mind. What you're going to do. And here are your options. Okay, here are the options. So these are the remedies, and you must know these options. It's very important. First thing is, of course, you can increase the face amount of the contract by 8%. Okay, so basically, every year, the coverage increases by 8%. So the idea is that if you increase the coverage, then the MTAR line should also increase with it. Okay, that's because remember I said to you right at the beginning that the MTAR line is based on your age, male, female, smoker, non-smoker, and of course, volume of insurance. So if you increase that $200,000, by 8%, let's say, so that's $16,000 more, let's say, in the year one, and then next year another 16,000, and so on and so forth. So it is quite possible then that MTAR line would have shifted, and therefore it shelters the amount of money. So that line basically now theoretically go up here, let's say. And so now you are within that line. So once again, you're safe, basically. Okay. So that is one option that is offered by the insurance company. And the good news about that is that there's no medicals necessary. So this is not an insurability issue. It's just automatically, if you chose that option, they'll just keep on increase the coverage by 8% a year. But remember also that your premium could also increase as well. So there are other issues that go with that. But in order to maintain its exemption status, about 8% could save you, based from that perspective. If you did not want to do that, if you didn't want the increase in coverage, then of course you can make a withdrawal. Okay, you can make a withdrawal of that premiums. In other words, you get money back out again. However, remember that when you're making a withdrawal, then it could result in taxable capital gain, because you're going to have to calculate now the prorated, prorated partial surrender, prorated ACV, because when you're actually removing money, remember in the previous video that we did, we talked about that partial surrender, so to speak. So the actual removing of money could be construed as a partial surrender, which basically then creates a prorated ACV, which again could create some taxable issues for you as well. So again, the option is there, and you have to look at which one is the better one. The last one, which is probably the more common one that most people will accept, is that every universal life policy out there has what's called a side fund. Some people call it a shuttle account. And so basically every universal life policy that is issued automatically has a shuttle account. And that shuttle account is designed to be essentially to take excess money. So when that amount of money is above that line, automatically you move it over to the shuttle account, basically. So that way it keeps the insurance policy as exempt. In other words, it keeps that MTAR line right on the mark, you might say, because this excess money now goes into a side account. There could be, again, in the process of moving that money to the side account, there could be some tax issues, but only for the money that's being moved over, not for the entire policy, obviously, just for the money. So let's say, again, an example, you've got, $20,000 that excess funds and everything else, you simply could move that $20,000 over. So rather than put it in your pocket, you put it in the side account. It could, of course, generate some tax issues, because it still would be considered a withdrawal of premium. So whether you put it in your pocket or whether you allow it to sit there on your side account, then it's still a withdrawal basis. So you still have the prorating aspect of it as well. Okay. And also in that shuttle account, you can decide then whether you wish to invest that money in whatever options that the insurance companies give you. So if it's interest only, that's fine. If you want to invest in some other funds, growth funds and everything else, that's fine. But remember that any growth in that side account will also draw a tax issue. In other words, the money that's sitting in the side account is not exempt. Okay, the money sitting in the side account, the shuttle account, will be taxed. The second generation income will be taxed. Okay, so the only money that's actually sheltered is the money that's actually still sitting in the plan as well. So theoretically, you could have an insurance policy which has an exempt status in terms of the policy itself, basically, and also non-exempt status in that it has a side account which is generating income for you, and you will have to pay tax on that. Again, that's a choice that you must make. But these are basically the three remedies that insurance companies will give you. You can increase the coverage by 8%. You can actually make a physical withdrawal, which again could generate some tax issues, or you can let the money sit there, but the money will sit in a shuttle account. And that shuttle account could draw, again, taxation depending on growth and so on and so forth, so all those issues. So these are things that remedies basically. Remember, all of this applies only to policies last acquired from December 1st. 1982 onwards. That basically policies that were issued prior to that had nothing to do with this whatsoever. And this in particular is really more on universal life because of the actual fact that you can put in more money, And so that's why the next thing we need to talk about now is how much more money can I put in? In other words, what are the provisions in terms of what if I want to put in more than just my normal everyday premium? In other words, I want to do a dumping of some sort. What are the ramifications for that? And we're going to look at that in a moment as well.